What if I told you inflation isn't an accident? What if every time your grocery bill rises, every time your savings lose buying power, and every time a currency crisis erupts anywhere in the world, someone, somewhere, makes money from it? Not a person you've heard of, not a public institution you've ever voted for, but a hidden network operating quietly behind global markets whose profits rise, specifically when the value of money falls. Here's the part nobody talks about. This system has been running for over a century. It shapes nations, breaks economies, and rewrites financial history, usually in the shadows, usually without fingerprints. Tonight, we uncover it. Welcome to the shadow network that profits every time money loses value. A system built on disappearing value. Before we get into the twists, the actors, the machinery of this network, we need to set the stage with a simple, disturbing truth. Modern money is designed to lose value, not by mistake, not due to mismanagement, but by design. The official story says inflation is the unfortunate side effect of economic growth. But historians know the real origin of this system wasn't about growth, it was about control. And to understand why a shadow network formed around it, you need to go back to the early 1900s. To a moment when the world quietly changed forever, because once you see how the system started, you'll understand why it can't stop. The birth of profitable decline pictured the financial world of the late 1800s. Currencies were tied to gold. Governments had strict limits on how much money they could print. A debt couldn't grow infinitely. Inflation existed, but it was rare, temporary, and tightly capped. But there was a problem. For empires trying to expand, for governments trying to finance wars, for banks trying to scale their lending, gold was a cage. Limited spending, it limited borrowing, it limited power. And so began a push, quiet at first, then louder, to create a new system. One where money wasn't tied to anything physical. One where the value of currency could be managed. And one where a select few institutions had the authority to do the managing. Enter central banking. But the real twist? Central banks weren't designed to stabilize economies. They were designed to expand the monetary base, because expanding the monetary base created something new. A predictable decline in the value of currency. And who benefits from a predictable decline? Not the public. Not workers. Not savers. But lenders. Asset owners, and institutions that profit when borrowing grows. The foundations of the shadow network were built right here. The network forms as the 20th century began. Three forces merged. Central banks gained legal authority. Governments discovered the power of inflation-funded spending. Private banking houses expanded globally, tying nations together through credit. Individually, none of these forces are mysterious, but together, they created something unprecedented. A global system that thrives when currency purchasing power declines. Here's the cause and effect. Inflation quietly erodes. Wages gives workers need loans, gives banks profit. Inflation raises the cost of living, gives governments borrow more, gives bond markets profit. Inflation reduces debt burdens, gives governments repeat the cycle, gives central banks reinforce it. But the true rise of the shadow network began in 1913 with one event. The creation of the U.S. Federal Reserve. Because once the world reserve currency had a mechanism to expand endlessly, other nations copied it. Behind every central bank, a predictable pattern emerged. Advisors, private financial institutions, international lenders, and interlinked networks that all benefited when money lost value. By World War II, this network wasn't just national, it was global. And after 1971, it became unstoppable. When money lost its anchor, everything accelerated. On August 15, 1971. President Nixon ended the gold convertibility of the U.S. dollar. No more gold backing. No more external limit on money creation. This moment changed the world more than any modern financial event. Without gold, all currencies floated. Without limits, monetary expansion became constant. Without constraints, inflation became structural. And for the shadow network, it opened the floodgates. Because from that moment on, every printed dollar lowered the value of existing dollars. Every lowered dollar increased demand for credit. Every increase in credit increased profit for the financial system. Every crisis made central banks intervene, expanding the system even more. Inflation was no longer a byproduct. It became a planned feature of economic policy. And planned inflation meant predictable winners. The era of permanent loss. As money lost its anchor, the fallout was massive and deeply unequal. 1. The middle class began shrinking. Inflation eats wages faster than salaries rise. But asset prices, stocks, real estate rise with inflation. Who owns assets? The top 10%? 2 nations became addicted to debt. Countries borrowed increasingly large amounts to cover deficits. Debt became the world's most profitable product. 3. Crises became more frequent and more profitable. Every crisis triggered interventions, stimulus bailouts, rate cuts, quantitative easing, all of which expanded the system, all of which weakened currency, all of which rewarded those holding the right assets. And every step of the way, the shadow network, global banks, international funds, rating agencies, financial institutions profit, not from stability, but from decline. Inflation makes savers poorer, but it makes lenders richer. Inflation erodes cash. But it grows the value of financial products tied to interest, fees, leverage, and geopolitical influence. Attempts to stop the machine over the years, there were attempts to fix the system. Wage and price controls, currency reforms, budget restrictions, balanced budget laws, anti-inflation campaigns, austerity programs, interest rate shocks, and everyone failed because none of them touched the real mechanism. Can't fix a system that was built to operate this way. And every failed fix proved one truth. Inflation isn't the malfunction, it's the engine. This is why inflation never permanently goes away.
Yes.
Why every temporary spike becomes permanent. Why every currency in history eventually falls. Why the shadow network has only grown stronger. It's the same pattern, faster than ever. Now let's connect this story to today. Because the pattern isn't just repeating, it's accelerating. 1. Global debt has surpassed $315 trillion. More debt than at any time in human history. 2. Over 60% of all US dollars in existence were created in the last few years, which means the value of every existing dollar fell. 3. Real wages have stagnated for decades, even as productivity rises. 4. 35 countries are facing currency crises right now. The shadow network thrives during crises because governments panic, central banks intervene, money printing surges, liquidity injections, inflate asset prices, and behind it all, the same institutions profit. Global banks, multinational lenders, hedge funds, bond markets, central banking alliances, and international financial organizations. When inflation rises, stock markets rise, real estate rises, commodities rise, corporate revenues rise, debt markets expand. The only thing that falls is the value of money itself, which is exactly what this network is built on. How the network profits. Let's break down the core engine of this shadow system. Mechanism 1. Debt becomes cheaper to repay. Governments repay old debt with cheaper dollars. Who buys this debt? Large institutions that earn interest long before depreciation hurts them. Mechanism 2. Inflation boosts asset prices. Inflation pushes money into stocks, property, bonds, commodities. Guess who owns most assets? Not ordinary people. Mechanism 3. Crises justify expansion. Every crisis gives central banks permission to print, governments permission to borrow, markets permission to inflate. The network thrives in crisis cycles. Mechanism for currency decline increases dependency as money loses value. Citizens need loans, governments need bailouts. Companies need credit lines, all from the same institutions. Mechanism 5. Fees and leverage scale with inflation. More money gives more transactions, gives more fees. More borrowing gives more interest, gives more profit. It's a self-reinforcing loop. The truth behind the system, here's the truth. We don't live in a system where money loses value by accident. We live in a system where money must lose value so the system can survive. Inflation is redistribution, not from rich to poor, but from savers to borrowers, from workers to asset owners, from the public to the network. Every time your currency buys less, someone else's portfolio grows. Every time you lose purchasing power, someone gains economic leverage. Every time the economy shakes, someone rises in the chaos. This is how the shadow network profits. This is how the modern financial world operates. And this is why it can continue quietly, predictably, and globally. 3 clear takeaways. Takeaway 1, inflation is engineered, not accidental. It is a structural requirement of the modern monetary system. Takeaway 2, the beneficiaries of inflation are centralized and powerful. The losers are decentralized. Everyday workers, savers, small businesses, and nations dependent on foreign debt. Takeaway 3, the system cannot reverse without collapsing. Ending inflation would end the entire global financial architecture, so the cycle continues. Ending warning plus open thought, the real danger isn't inflation itself. It's that inflation hides the transfer of power from the many to the few, slowly, quietly, predictably. If money continues losing value at an accelerating pace, then the question is no longer, how do we stop it? The question becomes, what replaces the system when it finally breaks? If this deep dive helped you see the hidden financial architecture behind inflation, then hit like, subscribe, and tap the bell icon so you don't miss the next investigation into the forces shaping our economic future. And share this video with someone who still thinks inflation is a mistake, because the real story is much bigger.